All right, I see there's quite a lot of people who've already joined us, so I think we can get started. So welcome everyone to this first webinar on the Web3 CFO Club, which is on accounting for crypto in 2023. There's a lot of changes in crypto accounting, so if you have crypto on your balance sheet and you're responsible for the financial operations, bookkeeping, and financial reporting of your company, you must be updated about these new changes. So I'm thrilled today to have a highly distinguished panel of guests of crypto accounting experts from Ernst Young and Lukka. We have Michael Gonzales, assurance partner at Ernst Young. We have Suzanne Morsfield, the head of accounting from Lukka. And we have Martin Grosvenor-Wong.
Good enough.
Also an assurance partner from EY. To share a bit what we're trying to do with the Web3 CFO Club, it's a community of finance and operations leaders in Web3, and we have mainly two objectives with this community is to share best practices for Web3 financial operations and to allow yourself to network with your peers in Web3. We noted that there's a lot of communities for devs in Web3, but the missing communities for finance and operations leaders like yourself. It's not easy to grow a business using crypto, and if you're alone, it can be pretty daunting. Today we've, let me start moving the slides. Today on the CFO Web3 CFO Club, we already have 300 members. It's growing fast, and we want to host webinars like these to help bring more clarity on how to run a business on crypto. So the agenda for our first webinar will give you a quick update on FASB and IFRS on what you have to know for crypto accounting. We'll speak about the treatment for stablecoins and focus on the most widely used one, USDC and DAI. We'll speak about fair value measurement. We'll speak about audit evidence with crypto on your balance sheet. So what kind of information you're required to give to your auditors when it comes year end, and we'll have a small Q&A at the end, which should be 10-15 minutes long. Of course, a disclaimer before we start is that this webinar content is for general information purposes only. Different accounting treatment could apply to your specific jurisdiction, and you do have to consult with your professional accounting and tax and legal advisor. This is about the Web3 CFO Club that I already shared.
That's the DBHDS taxonomy, but there's like similar.
And why don't can we start with a quick round of intro from our speakers today? So Michael, could you tell us a little bit about how you're involved with crypto?
Sure. And Umar, I think we have someone in the chat requesting that we go to presentation mode on the slides to make them a little bit bigger. But thanks for having me. Michael Gonzales. I'm a partner at EY based in New York, and I sit in what's called our national office. I focus on audit methodology and enablement and audit consultations for our assurance clients that get into crypto, blockchain in any material way. So really developing how is it that we audit crypto, right? It's pretty, at least at the very beginning, right? New and novel. I think even today we still are confronted with a range of challenges in terms of how do we apply auditing standards to this type of activity. So that's been a big focus of mine for the last 3 years. Suzanne, you go next.
Thanks. Hi, I'm Suzanne Morsfield, and again, thanks for inviting me. I'm delighted to be here. I'm the global head of accounting solutions for Lukka. So what we are is a data and software provider, and specific to institutions that are engaged with crypto. So, and one of the things we do is help folks comply with accounting and tax and other regulatory needs across the world. And I have a long background in financial reporting and was at EY actually in my early days. It's also on the buy side and the sell side at JP Morgan and Morgan Stanley, respectively, all about financial reporting and how to use it, how to help it make sense to readers of financials. And so when I think about accounting for crypto, I'm always thinking about that, with that hat on. Not only should it be compliant with standards, but also helping standards and standard setters think about, is it making sense? Can users use it? Use the information we provide to them in a way that helps them understand and make companies and make decisions about buy, sell, hold, or short. So that's me.
Hi, and I'm an assurance partner also at EY, based in Hong Kong. So I work in professional practice, which is similar to what Michael described as the national office. As part of that, one of the hats I wear is to sit on our global IFRS subject matter group for crypto assets. So that group deals particularly for supporting our audit engagement teams around the world in supporting their clients around technical matters to deal with digital assets. And then also, particularly within Asia Pacific, I deliver advisory services to our clients in digital asset space, going back, I think, 5 or 6 years now. So since the ICO days is when I started providing accounting advice on these topics. So pleasure to be here.
Thanks, Martin. And lastly, quickly about myself, since this is the first webinar we're hosting. So my job here for the Web3 CFO Club is to grow the community and organize different initiatives like this webinar we're having today. We're also hosting an in-person event at ETH Denver for everyone who's coming. And if you haven't joined yet, you can do so. I did share the event in our Slack group, and I will be sharing the link to the actual invitation tomorrow. And so for this year, what we want to do, we want to have more initiatives like this one, or to meet in person. We shall be creating the second Web3 CFO guide that we published last year was the first one. This year we'll do the second version. So if anyone is interested to be a contributor in the second version of the guide, please just feel free to reach out to me on Slack. And yeah, I think we're good to go. And yeah, just lastly, I mentioned there that I also run a podcast on Web3 accounting called The Accountant Quit. So if you're interested to learn everything about Web3 accounting, what's going on, the different tools coming up, so you can feel free to check that out. So the first topic for today is on the different updates from FASB and how FASB then differentiate itself to ISB or IFRS. So in May of last year, FASB decided to add a project on accounting for digital assets, and ever since they've been publishing guidance on the scope of this project, what kind of crypto assets should be included, fair value measurement, disclosures to have. And in February of this year, they issued an exposure draft of a new crypto accounting asset standard, and this has a 75-day public comment period, if I'm not mistaken. So that's good news for crypto accounting. If you're working in crypto accounting, your prayers are being answered. I don't know if they're being answered fully, but we'll find out today. So I want to ask you, what are the pain points that of the current accounting treatment for crypto that this new standard will address? Maybe I can start with Michael.
Yeah, I think at a high level, right? The accounting for crypto as an intangible asset introduces a very odd measurement in that you're essentially having to book down the asset to the lowest value that it ever hit since you acquired it, whether you purchased it or whether it was paid to you as consideration, for a service or good that you sold. From that point forward, you're constantly tracking whether or not fair value has dipped below your basis. and if it has, then that's your new basis. If it goes back up in value, you can't go past what you had written it down to. At least under US GAAP. I think, Martin, you could probably speak to how this works for IFRS, where there's some, I would say, conditional or provisional way that you could write it back up. But in US GAAP, you cannot, right? You cannot write it back up. And this creates, I think, from Suzanne's earlier point about utility to users, is it meaningful that I bought Bitcoin at 25, it dipped down to 15, and now it's back up to 25, that I have it booked at 15? And you might react one way for Bitcoin, but if I go down the list and think about a lower market cap crypto, maybe you feel a bit differently. But I think the general kind of the general view of the FASB appears to be that fair value is more decision useful. But this was really a long time coming. I think a lot of industry has already said this is always the right answer, or has been the right answer from a decision utility standpoint to someone who's reading the financial statements. That's a much more meaningful measure. To have it be at fair value or even recoverable impairment would have been better, right? So a step in the right direction. I will say this is scratching the surface of the accounting issues that that companies sort of deep into the space face every day. This is probably the easiest issue because you can really get some consensus around fair value making sense for, at the very least, the largest market cap crypto, or the ones where there's deep and liquid markets for that particular token. So I don't know, Suzanne, if I covered that, or if Martin, if you want to elaborate more on contrasting with IFRS. But
I think you covered it great, Michael. I think the thing just to alert the listeners to is that it is for a subset of crypto assets. It's not for all of them. So, for instance, NFTs are left out of this new improvement. Those will always have to be held at this impaired sort of cost sort of model, where it goes down and then it stays trapped down. And we could have a really great discussion about whether that's good, bad, or indifferent, but it's just good to alert all of you to it's not every crypto asset. And then with the new rule, the new rules coming, there's also extra disclosure and extra ways you have to present it on your balance sheet and these things on your income statement that we can talk about if you want as well. But there is more info that's coming to the marketplace, as well as the new measurement sort of approach.
Yeah, and I think as they both alluded to, there are some similarities and differences between US GAAP accounting and IFRS accounting. So similarly under IFRS, it's the majority, not all, of crypto assets or digital tokens are considered to be intangible assets. There are some exceptions, but very few exceptions. There actually is a possibility under IFRS to fair value all of these assets, but in a very limited circumstance where you are acting as a broker dealer. And that was really relying on assessing an entity's business model. So are you acting like a securities firm, basically? In which case you can do what you want, fair value, and that's the answer. For everything else, we have a very strange model under IFRS where it does allow fair value accounting, but instead of all going through the P&L, but essentially your losses go to the P&L and your gains go to other comprehensive income. So you end up with a uncomfortable mismatch between these measurement models. And I think it's worth thinking about that under IFRS, we're dealing with a standard that was first drafted in 1994 and finalized in 1998, and really has had no updates since then. And even before the development of crypto assets, people were already thinking it was a relatively unsatisfactory standard for 10 years, 15 years at least. I would contrast with the FASB that the ISB currently is doing nothing about this and doesn't really intend to do much in the foreseeable future. So we're not going to see the same movement which we're seeing within the current exposure draft from the FASB.
But Martin, one of the pain points with US GAAP was because it was previously recognized at cost, and you could not reflect the actual market value of the crypto. But with IFRS, you can adopt a cost model and you can adopt a revaluation model if you can prove that there's an active market.
Great, thanks. That's a really important clarification. So for a financial asset, you can fair value irrespective of whether there's an active market or not, and you call it, you have mark to market or mark to model. For crypto assets and intangible assets, we only have mark to market as an available choice. So only a small population of crypto assets are eligible for this model, and ultimately there's a significant degree of judgment around what constitutes an active market, both for preparers and also particularly for auditors. And the boundary between the active and inactive markets, I think lots of people have very strong opinions on.
If I can just follow up on that, because it's such an interesting point, that this boundary between inactive and active markets, and I jump on it partly because we at Lukka are working with some academic researchers at Rutgers who've been looking at that definition and trying to understand where is that line? Has anyone defined it? Is it in GAAP? Is it in IFRS? Has the SEC rolled on it? Has any regulator said, here's the line? And as it turns out, there is no official line. And again, to just alert the listeners, I know Michael and Martin, you know that, but there isn't any official line. There are unofficial sort of rules of thumb, and the SEC did write a research paper many years ago to look, and came up with some approximate rules of thumb, but it's not hard and fast. There's no bright line, and so we're working on some research to sort of help bring some color to that and maybe some insight to all of us. But there isn't a bright line, just to point that out.
And I think it's interesting that preparers and auditors treat these different asset classes differently. So for a financial instrument, what we call P times Q or price times quantity is an almost sacrosanct idea. And as long as there is a price and there's a financial instrument, we start there, and you have to argue and argue and argue to move away from it. Whereas we take the opposite approach, it seems, for crypto assets, where unless it's deeply liquid and pretty much trading on that day and every single day, and also particularly trading towards fiat rather than against another crypto, it can be quite hard to justify an active market.
Which I think is this other really interesting point to just, and I don't know if we want to discuss it more, but like if you're, for the audience, like if you're trading a crypto to crypto asset pair, you can run into that your auditor will say it can never be an actively traded asset, even if it's happening a lot, out there. And so it's just, again, something, as Umar started us all out, reminding us to make sure we're talking to our accounting advisors on all of these things. That's one area where you can really see that auditors, will have views on to help.
Mm-hmm.
Yeah, maybe Suzanne just tease that out a bit more, right? I don't know how much work standard setters have done to figure out market structure and the fact that these kind of multi-hop trades, right? So a lot of cryptos, they trade against stablecoin pairs, right? So I know we're about to get to stablecoins, but whether it's USDC, USDT, or even an on-chain collateralized stablecoin like DAI, okay, a lot of the market liquidity is not directly to fiat. So should I discount that as like irrelevant to my measurement? It's interesting to kind of think through this. I'm not sure they've kind of fully run that down, and I would hope that in a public consultation, when the FASB comes out with their proposal, that a lot of these kind of issues get kind of raised and basically say, hey, if a crypto's trading and part of the market depth is from trades versus ETH or trades versus wrap BTC, why are those irrelevant if the two parties are basically transacting at arm's length, and that's an actual trade that actually happened? Am I supposed to discount it or ignore it simply because it did not take place in the fiat currency that US dollars, right? That's just I understand that point of view for sure. I get where it's coming from, but I'm just not sure it's, again, if you weigh it against what we're trying to accomplish is maximizing relevance to users of financial statements. How do I do that? How can I let accounting be the storytelling mechanism it's supposed to be, while being representationally faithful of what's happening in the market?
And it's funny too, because I've been spending a lot of time. I am an accounting nerd. I need a podcast called The Accounting Nerd, I think. But I've been spending a lot of time in the fair value standard over the last week or two. And one of the things that just really has jumped out at me is it just says over and over again, the point of this exercise that and these principles is for you as the reporting entity to come up with an estimate of if you were to sell this asset on this day, what would you get for it? And regardless of if there's one hop or two hop or whatever, that's all we're trying to do is just signal to the marketplace, signal to readers, what could I sell this for today? In a reliable way, in an arm's length transaction, as Michael points out, in an orderly market between, kind of normal market participants. And so I keep thinking about that underlying objective and principle as I'm thinking about fair value and the valuation of these things. And what is the underlying point, so.
Yeah. I think it's interesting if we think from an IFRS or an IASB perspective, there are certainly some board members who seem to strongly express the view that if every asset on every liability on the balance sheet was fair value, then the accounting would be perfect.
Mm-hmm.
So when IFRS 9 was first written, everything was going to be at fair value, and then obviously it moved along, and now we have mixed models. And yet again, then we come to this asset class, and we seem to can't get past this. Well, we don't have fair value for intangible assets, so deal with it. It almost seems to be the implication.
Mm-hmm. Right.
You date yourself when you say that you remember when everything was supposed to be at fair value on the balance sheet. It just totally gives away. I remember it.
The first draft of IFRS 9, 2000, and I don't want to say long time ago.
Before
I'll
Bitcoin.
move on
That's what it is.
I'll move on to the treatment with stable coins because most crypto assets do fall under intangible, but not stable coins. They can be different forms of collateralization with stable coins. Is it fiat backed? Is it crypto backed by one or multiple crypto assets? So I wanted to take USDC, a fiat backed stable coin, and DAI, a crypto backed stable coin, to discuss a bit the difference in the accounting treatment for them. Usually, to determine the appropriate accounting for a stablecoin, the holder will have to determine if this represents a financial asset. There's many factors to consider when accounting for stablecoins: their redemption rights, collateralization, like I said, counterparty risk. And so we know the nature of these two stablecoins, USDC, fiat-backed, DAI, crypto-backed. What's the approach to account for them?
So, if it's okay, maybe I can start by asking the
Yes.
question before that question, right? Why does it matter, right? So let's think about if both of these, assuming they hold their pegs, and I know both of them have historically, these two on the screen have held their pegs over time. Whether we're at cost basis or fair value, I'm not sure it matters too much, right? Because they're both just holding at $1. So your first instinct would be, well, it doesn't matter what I call it. Financial instrument, intangible asset, doesn't matter. But the thing is, I know in US GAAP and probably to a varying degree in IFRS, there's a distinctly different accounting model for what you do with that asset afterwards. So, for example, if I lend out or I transfer a financial instrument versus I do that with an intangible asset, whether or not I account for the transfer as a derecognition event or a lending or some sort of a transaction that remains on my balance sheet, it pivots on at least partially on what model I'm in. Am I in the financial asset derecognition model, or am I in the intangible asset derecognition model? And at least for these two on the screen, DAI, I think we would all say, is an intangible asset, and USDC, given that it is issued by a centralized issuing entity, and it effectively is a claim on that entity's assets that they control. That's just essentially a debt instrument, very akin to a bank deposit. Not quite cash. I think we haven't gotten all the way to saying it's like cash or cash equivalent, but we have settled that that's Circle's debt. That's a debt instrument that you hold as an asset holder. That's distinctly different from an intangible asset like DAI. So it's that it matters not because of how it would be measured. It matters because other things you might do with it could differ based on what model you're in, right? I don't know, Martin, Suzanne, if you.
I would echo exactly what you say, and then maybe just to bring back something you said before about relevance of financial reporting, but also comparability. That if we have two transactions which are ostensibly the same, but we have to account for them in two different ways just because of let's call it an arbitrary distinction between whether it's a financial asset or an intangible asset, well, then that isn't helpful to anyone reading financial statements, whether that's investors, regulators, your customers, or even internal management. And the same would be that you have transactions being done in the space which are ostensibly the same as transactions being done by a bank or a securities firm, and they're also being accounted for in different ways, even though the economic effects of these transactions might be very similar. So it's not helpful. Yeah.
It really isn't. And just to echo both of you, one of the things I remember when I was first getting to know the accounting for crypto, and ran into this notion that you both have hit on, which is just, it's one thing if you're just holding various crypto assets on your balance sheet and you're holding them and you're going to sell them later, hopefully, for some kind of gain. But the wheels fall off the wagon the second you go to use it for any other transactions. Yeah. The economic meaning prescribed by accounting rules and this classification, trap that we're all stuck in, and then the wheels fall off the wagon in terms of your ability to communicate to users of your financial statements what's happening. Because as Michael pointed out, if it's an intangible and I use it, to buy, you can buy or sell a hoodie, but it's a barter transaction essentially. I'm rocking up and want to buy some milk and I got a chicken, for you, in exchange. I mean, those are tangible assets, but this is kind of the parallel. And if it's intangible, it becomes, you end up with embedded derivatives really quickly and, all of that. And again, with these two particular stablecoin, if they aren't losing their, getting the peg holds for measurement, if you're just holding it, it's less of a drama. But the second you go to use it, that's when all these other kind of issues can really rear their ugly head pretty quickly. The one thing I spoke with some folks at the FASB at one point about stablecoins and about where they kind of how they think about the characterization of them, and what really is key in their mind. Like with USDC, I'll give just there an example, an analogy, or not an analogy. It's an example. Is just if there is that contractual right where I hold USDC and they have to give me $1 for one USDC, that contractual right, as you've also touched on, Umar, in your rights and obligations sort of analysis pointer to everyone, go look at that. But the right to the one-to-one is really critical under US GAAP to getting it to being treated as a financial asset. Not just that there's full reserves, it's that you have that claim, as Michael also pointed out, a one-to-one claim. So.
Maybe we can speak about fair value measurement now. So fair value measurement is a hot topic. We spoke about it earlier. So now, I mean, I'm speaking for US GAAP because previously it was at cost, now it's at fair value. So all increases and decreases must be recognized in your other comprehensive income. The approach for valuation is that you first need to identify what's the principal market. We spoke about active market before. And you have to maintain like a consistent approach with regards to the pricing source of your crypto assets. I've listed a few challenges here on the slides that crypto markets never close. So what cutoff time should you be using? And again, you have to be consistent. You have different prices for the same assets on different exchanges. And there's also like a lack of standardization for the identification of crypto. For example, equities, bonds, commodities that we're familiar to, they carry a ticker symbol. So in light of these challenges, I want to ask you, what are the good practices when it comes to valuation so that the auditors will be happy at year end?
Yeah, just maybe clarify one thing. The changes to US GAAP are pending. They're not final. They're not even not even proposed yet. We don't. The official proposal is probably going to be another month or two. There's going to be a comment period where the public can comment on the proposal, and then the board has to redeliberate. And in some cases, we've seen them go out for exposure number 2, right? A follow-up exposure because of all the comments they receive. So I think that's actually unlikely here. I think they really do want to push to have a final standard. You know, as soon as they can get comfortable with what the final words are going to say. But they do have to go through their very deliberate due process. So don't book things at fair value just yet. That's first. Second, it's not just a US GAAP issue. In IFRS, you have to track fair value for impairment. So you have to have a process, regardless of what your accounting model is, to be tracking fair value. And it's difficult for the reasons you have here. But I'll probably, because I'm more focused on auditing, I can provide some auditing perspectives after maybe Suzanne and Martin can maybe tackle the questions that are up there on the screen, and I'll provide some audit observations at the end.
Yeah, so I think, I mean, if we remember that the purpose of accounting is to communicate information, right? So IFRS 13, as well as being a measurement standard, is just as much a disclosure standard. And in fact, requires quite voluminous disclosure, including narrative disclosure around what your valuation policies, what your principles, how do you make these judgments? For so many of these judgments, there is not necessarily a right or a wrong answer, but what's more important is communicating what you as an organization have done, and then being consistent from period to period, or being able to explain those differences. And I don't want to talk too much about the auditing, because that's for Michael, but I mean, it's having a governance around these processes as well. So not to have the perception that you can pick and choose the price that you want, but there's appropriate governance controls and procedures around valuation.
And I can sort of chime in as well. I mean, one of the things, without being salesy at all, one of the things that Lukka does is help identify the principal markets for a whole host of thousands and thousands of crypto assets. We can help do that, and so there's these practical kind of questions that come up when you take this sort of theory from the fair value standards that are very principles based. So you got principles out there. There's not a precise recipe. First do this, first do that. It says, you got to have a principal market if you can. If not, you go to this thing called the most advantageous market. But under principal market are a set of ideas and guidelines, but not a strict prescription. And so we sort of see this issue, this subset of issues that come up that we can help with, and having a good tool or provider can help with, because what you've got is the principal market has to be, it has to be one that you choose. And again, the governance around it, where the information quality is good there, where it's not just, because principal market is supposed to be the market with the most volume and frequency of trading. That's what the standard says. But is that volume fictitious? Has it been just built up with lots of round trip trading? And so you need have a good quality exchange, and you have to have some governance and thought around that in your accounting policies. Again, I'm not prescribing to you how to do it. This isn't accounting advice, but advice around things to think about. How is, sort of looking at volume? Where is volume? Can it be that how do you define access? Because one of the things in the standards is this a market you can access or not? And as it turns out, different auditors have different definitions of that access. Is it access where you literally can't legally get to that market, so you can't treat it as a principal market, or you're planning to be in that market next year, and so you can, or before the end of the reporting period. So this definition of do you have access or not matters. The cutoff is a big thing, and again, being consistent there is what we have heard from auditors, and our customers, that is they have a policy, they're consistent, it's always 00 UTC, or it's always that close of the equity markets in your local market where you look at fair value. There's just a variety that's allowed there, but being consistent and having good policy and governance around it. The other question that comes up is, can I just average? Can I just take an average across all the markets out there and call that my fair value price? And really, that's generally discouraged, because you are supposed to identify a hypothetical exit price from a principal market, and so just taking an average is usually discouraged. But there are tools and approaches that can really get you, to an answer that auditors are going to be happy with. So.
Maybe Suzanne, just to follow up on kind of the point of the average from an audit perspective, that's probably the one thing I prefer not to see, right? Googling something, a price, and just clicking on the first thing that hits, and then saying, "Oh, gives me the price of Bitcoin, the price of ETH." I go to the historical, December 31, whatever my policy says. I click on that and booking to that. You don't know what actual markets make up that composite price, how they're weighted. So both GAAP and IFRS would say it's a market, it's your principal market. Identify it, book to what that market had, as price as of that time. The interesting thing, I guess, in that sense, I see a question around DeFi. This kind of gets to the point, Suzanne, you brought up about access. Is it literal access, or is it also your risk appetite? Well, I'm not set up to participate in DeFi from a risk perspective. I have risk standards that won't allow me to participate in it because I can't identify who the other parties are, or whatever it is. There could be reasons why you choose not to access. So what's interesting there is that I can see that manifesting in cases where you have a token with less trade volume, right? And you might say, well, the most active of the markets, if I had to pick one, is a market I can't access. Well, what are you supposed to do in GAAP? Even if you conclude something is not trading in an active market that you can access, you still have to maximize observable inputs. So that data is still relevant, just in a different context. It's no longer principal market. You're making your best effort at estimating the fair value, and you're not supposed to ignore the most relevant information, and that might be it. The DeFi going rate might very well be the best data you have, but it probably depends on the specific situation. But I think that's an important thing to think about. I see a couple other questions in the chat. Do we want to take them? I see one about. Can we go back to Umar? You had the scope of the FASB project on the slides earlier.
Yes.
Can we go back there, because I see a question here about, you might hold the native token of a layer 1 blockchain in order to at least pay the fees to transact on that blockchain. So there's a go back one more slide. You had it highlighted on scope. One more back. Yeah. So scope bullet 2, do not provide the asset holder with enforceable rights. I think I'm suspecting that FASB is very intentional in using the word enforceable, right? Does Bitcoin give you the enforceable right to use the Bitcoin blockchain? No, but is that a typical commercial expectation that you could pay transaction fees on Bitcoin blockchain with Bitcoin. Yes. So I think that's probably the word that you'd point to and say that's why Bitcoin Ether. And I don't know, Martin, Suzanne, if you read it differently than me.
No, I read it the same way and have heard sort of feedback that the expectation would be that Bitcoin and ETH are within this.
I would read it the same way, and I would see it that what it's trying to exclude is white paper only ICO style platforms which maybe did or did not materialize as they were anticipated. Yeah.
Right. It is interesting though, because I have come across fact patterns where a company looking to use blockchain for other purposes accumulates the native token, like a chunk of that native token, just to pay the transaction fees. So classically, if you didn't tell me if it was that it was crypto, I'd probably call it a prepaid expense.
Yeah.
But once you hear it's crypto, you suddenly change your mind and you say, oh no, never mind, it's an intangible asset. Which is kind of curious, but it's what it is.
We can take the other questions at the end. So I'll just ask everyone, you can just feel free to drop your questions and we'll have a short Q&A very soon. Let's move on to the slide regarding audit evidence.
Sure.
So if you're holding crypto on your balance sheet and you need to do your audit, the auditor, EY, will be required to do a series of tests to check the completeness, existence, valuation of your crypto. So we're lucky today to have two assurance partners who regularly see entities with crypto on their balance sheet. So I want to ask you, what would be the guidance you would have for everyone today, all the CFOs, accountants today, that could mitigate the risk of just getting bad news at the end of the audit? And also, something I want to touch on is with the recent fiasco of FTX and other centralized custodians, what did that teach us?
Yeah, I think recent events have only emphasized the points that we've been making as auditors for several years now, which is there's two ways to custody crypto. One is self-custody and the other one is third-party custody. For self-custody, we focus on who can get to the keys within the entity, right? Just your classic, who has access to the keys? Do you have good controls, whether it's a hardware wallet, software wallet? Have you been thoughtful about designing who can actually transact on the blockchain? Over time, institutional custodians have popped up in the space. And the next question was, well, since I can't see how that organization actually manages the private key lifecycle, right? From key generation, maintenance, destruction, whether and how often and how exactly they reconcile books and records to the blockchain, customer claims, customer books and records, right? How are we going to get comfortable that the crypto even exists? Do we just send a classic audit confirmation and hope for the best, or do we need to have a window into how exactly they run their shop? So at least in the U.S., and I think around the world there's probably a good handful as well, but in the U.S. there's now 8 institutional crypto custodians that provide these service organization, SOC reports around the controls of the custodian. They're all relatively high quality, and they're a specific type of SOC report that supports financial reporting, which is a SOC 1 Type 2, right, report. That's what we look for. Without that, then our next question is, are you at least, is custody with that third party at least segregated address, wherein you can see your own balance and your own address on chain and reconcile it transaction for transaction at the timestamp by timestamp with your own records match up with what you can independently obtain on the public blockchain. So that's a good fact pattern. The fact pattern where we continue to be challenged with, and I think there's no solution other than getting a SOC report or something equivalent, is if at the balance sheet date custody is in a commingled address at a custodian exchange, custodian or exchange that doesn't maintain segregated addresses for each customer, i.e. commingled address. How do we get comfortable as auditors that those assets actually exist? And I think before November, some people were kind of curious, hey, where's this kind of concern coming from? Is this a real concern? And then after November, nobody asked me that question again. Right?
And I think, Umar, you said, well, how do we make sure that we don't have a surprise at the end of the audit? But all those questions that Michael alluded to, they will get asked before you even get accepted as an audit client. As we do client onboarding, we say, well, how are you custodying? How are you comfortable with your fiduciary duties with respect to the assets which you're holding? And if we can't get satisfactory answers to those questions, we simply walk away. And even more so since November, where everyone's risk appetite has changed.
Yeah. And Martin, to that point, it's management's responsibility to support what their books and records have. It's not
Exactly.
the auditor's responsibility to go recreate kind of the fact patterns or obtain independent. Well, we of course obtain independent evidence, but we're not creating evidence out of nothing, right? Management needs to have a process to support its own books and records. And what we like to see, even I guess it's only really possible when you have the segregated addresses, but if you're going to reconcile to the blockchain, do it independent of your custodian. Don't use the custodial interface and reconcile to that, because kind of what's the point, right? I think what you want to do is you want to do maybe a three-way match: internal books and records, third-party custodian, public blockchain. Do those match, right? And you might want to do that on a automated or constant, frequent enough basis so that you can say, has my custodian messed something up or did something to my balance that I didn't authorize? So
we have a few minutes left. I think we can move on to Q&A. So everyone in the audience, if you have any questions, I see there's one question from Andre. So if there are no enforceable rights given to token holders, does it mean that proof of work miners should not apply ESC 606 to their mining revenue? It's a very specific question.
yeah, it is. I'm trying to recall the technical accounting answer here, but I thought that even if they didn't apply 606 directly because they weren't in the scope, you end up analogizing to 606 because it's the only model that tells you when you can recognize revenue anyway. Like the only comprehensive model in GAAP that tells you. So I'm not sure there's a big distinction there.
That sounds right to me, without giving accounting advice as well, that there is, even if it's not direct, there's a lot of analogizing that has to go on at times. There's a lot of times where it doesn't, but for the various crypto transaction accounting, the analogies that get us to embedded derivatives, the analogies that get us, to recognize revenue properly. I think that's right. And again, not giving you advice, but
there's
one thing
another question
to maybe mention really quickly, because I saw a question that made me think of this, and so maybe it'll come up, but just in case it doesn't, is that it's really important for everyone to realize that the SEC may define crypto in a specific way. The IRS, your tax authorities might define it. U.S. Congress or policymakers around the world can define crypto as a security or put it under the commodities regulator or whatever. That does not change the accounting classification. People don't always realize that. Accounting classification comes from the accounting definitions, and unless those get changed to match something the SEC is saying or thinking, or Congress or the CFTC in the US or whatever, it doesn't work that way. So accounting definitions will stay the same regardless of what's going on in other discussions. And so don't assume, if if Congress makes Bitcoin and ETH, under IRS, it's already technically a commodity, but we don't use a commodities accounting model for these the intangibles or financial assets or whatever. So.
Yeah.
And I think the thing that made me think about that was someone asked a question about Paxos and the SEC's approach to BUSD, and there will be an SEC approach and definition and rulings, and then there's the accounting definitions, and they don't necessarily talk to each other.
Right. That's right. Yeah, I actually just looked it up. I just wanted to make sure I had the 606 messaging right. I think the way we've interpreted it under US GAAP at least is that transaction fees are identifiable to the kind of the payer sender on a transaction. So that would be a 606 contract. Whereas block rewards is just kind of more ephemeral and there's no contract, but you end up accounting for it under a 606 model anyway. So again, a distinction without a real difference.
I see a question on staking rewards.
Yeah,
I'd
point to the same. I would point to the publications that Martin and I have dropped into the chat here. There is a staking section in the EY publication, but it basically says very similar to kind of how we think about miners. Consider whether or not you have a contract with a customer. That's kind of at the heart of kind of the 606 analysis, the revenue analysis. There are nuances depending on where you are in the particular staking sequence as to are you a principal, are you an agent? That can get a little bit hairy. But hopefully what I've shared is helpful in providing some principles. I know some of the other accounting firms have pretty good publications out there as well. I'll share ours, but
Yeah.
I would look at the range of publications that are out there because they'll get into. They'll have their little, I would say, hobby horses where they'll spend more time than the other firms talking about a particular thing, maybe because they have more direct experience with it.
Yeah, but there tends to be a relatively high degree of consensus between all the accounting firms because we do talk to each other about these topics. Yeah.
Right.
If there's no further questions, maybe we can close the webinar today, or maybe I just give 1 minute for any more question coming in. And also, if there's anyone in the audience who are not actually in the club, in the Web3 CFO club, so I'll just share the link of where you would be required to fill a form and join the club and get access to future webinars like these. And also just let us know the next topic you want us to cover. Should it be, I've been thinking about DeFi accounting or more focus on NFT accounting. Just let us know in the Slack group.
One thing I could just remind everyone, if they don't mind, when the FASB publishes this draft for sure and opens it up for public comment, like just encourage people to actually write in and give your input because they really do listen to it. They really do take it on board. They really are, I have found them very engaged with the industry and really wanting to hear from all of us. It's been really remarkable. I used to work at the ISB, and I know how much sort of outreach and work goes into trying to make sure that we do standard setting well when we're on that side of the table. And so here's a chance for all of us to give them input, and they will really, really listen to it and take it on board and see if they might just not agree with our input in the end or make significant changes, but they also might. So it's really worth weighing in.
Indeed, they do read all the letters because I was there. I was at the FASB as well, and we read all the letters.
Yeah.
It takes a lot of time.
All right then. So I think we're good for the first webinar. I'd just like to thank all our panel today, Michael, Susan, and Martin. Thanks for your time, and thanks to everyone in the audience. Thanks for your question. Again, just let us know the next topic you want us to cover here. And yeah, I hope this was helpful and cleared some of the doubts that you had about crypto accounting.
Thank you.
Great.
So much.
Thanks for having us.
Thanks, everyone.
Bye.
Bye-bye.
Bye-bye.